Yes, the other day, Saturday, we've learned about master budget. Master budget has two different categories. One is the operating budgets, and then the second one is financial budgets. So under operating budgets, all the budgets, whatever are listed, we have understood about how to prepare those things. Few numerical examples also we've tried. Um, Now we'll move to the financial budget, but then financial budgets under that, the first item is capital budget. Capital budget, the next chapter anyway is capital budget. So right now we are not touching upon the capital budget part of it. We will go ahead with cash budget. So cash budget is the next thing. So from the exam kit, we'll take up the questions about cash budget. Cash budget has three main parts. The first part talks about the cash receipts, whatever cash was received during a period. Then take out, then calculate or assess how much of cash payments are needed to be made. Then whether there would be a surplus or deficit is understood. This part of it from the examination kit, let's take it up and then work it out. I'll put you to the examination kit and then let's take up. See on the screen from the examination kit 292, it says Vincent is preparing a cash budget for July. His credit sales are as follows. So April, May, June actual sales are given to us 40,000, 30,000, 20,000. And for the month of July, estimated sales of 25,000 are given to us. His recent debt collection experience has been as follows. Current month sales are 20%, prior month sales are 60%, sales 2 months prior 10%, irrecoverable debts is 5%. How much may Vincent expect to collect from credit customers during July? So here I have mentioned that see, a cash budget has three different sections. The first one is what are the cash receipts. So how much would be received during a particular period is what is the availability of cash with them. It indicates that. So the first section is about preparing the cash receipts. The second one is what are the cash payments? Cash payments. How much would they have to pay during a particular period? So what would be the payment is what has to be calculated. After that, we find out whether there is a surplus or deficit. Surplus or deficit has to be calculated. That is to understand whether the receipts are more than the payments or payments are more than receipts. So here, this question, when we see that it's asked that how much may Vincent expect to collect from credit customers during July. So it is not talking about full length cash budget question, but there is only one bit which is asked: how much would they collect from the customer? So it's only a part of the cash receipt. So we would be only looking at this one. Let's take it up. So question number 292 on the screen. Let's take it up. See, there is a pattern in which the amounts are collected. It says that they are preparing a cash budget for the month of July. So only one specific month, which is month of July, is considered. The credit sales are as follows, which means that when the sales are made, all the amount is not collected in the same period. That would be cash sales. Nor it is prepared, it is sold as credit sales and then the entire amount is collected in one go after a period of time. That is also not there. Here we see that a percentage of the amount is collected in each of the months. It's not 100% collected in the next month or following month or whatever it is, but there is an installment system which is followed here, and those details are given. So in the past, some sales were made, out of which a percentage of the amount is collected in each of the months. So we see that his recent debt collection experience has been as follows. Current month sales are 20%, which he would collect, and then collected from prior month sales 2 months prior, and a percentage of the amount is not collected, which is 5%. So let's start cash collection during the month of July. One second. Let's wait for some time. The other college students are finding it difficult to log into the account. So I think in few minutes they'll join. So then we'll resume back. Until then, wait. So question number 292 says, Vincent is preparing a cash budget for July. His credit sales are as follows. Then we have April, May and June. The actual sales are given. And for the month of July, estimated sales of 25,000 is given. Then from the recent debt collection details, we see that current month sales, 20% of the total month sales are collected in the same month. Current month sales, then prior month sales 60%, sales 2 months prior 10%, and irrecoverable debts are 5%. So considering that, we need to find out what is the amount of cash collected during the month of July from customers. How much may Vincent expect to collect from credit customers during July? So let's start. Cash collection during the month of July. So how much amount was collected? Then first let's start with the same month. The same month is July. July's sales are of July sales, only a percentage of it is collected, which is 20% of it is only collected. And sales are 25,000. 25,000 into 20%. Next, prior month. Prior to July would be June. June sales are 20,000. From the prior month sales collected are 60%. So 30,000 into 10%. 5% anyway is irrecoverable, that is bad debts. So the total amount which is collected is 20,000. So cash collection during July. $293 DRF's projected revenue for 20X9 is 28,000 per month. All sales are on credit. Receivables accounts are settled 50% in the month of sales, 45% in the following month, and 5% are written off as irrecoverable debts after 2 months. What are the budgeted cash collections due for March? So here it is given as, let's say that in a particular month, if the amount is sold, the sales happen in a particular month. Let's say month 1. Entire amount is on credit sales, but out of this uh, total sales, a portion of that is settled 50% in the month of sale. So a part of it will be collected during first month only, first month. Another part of it, which is 45%, is in the second month. 45% in the following month. So that's what is given. 5% anyway, it's bad debt, so it will not be collected. So here, of course, the previous question very specifically has mentioned as to when the sale happened. But here now we have to um, let's say if the for the month of March, if the sales are made, 50% of March sales will be collected in March, 45% in April. So this is forward looking, but then we want it not about when it would be received, but how much is received during this month. So we need to look into the previous month. So if the month before March is February, so February 50% will be received in February, 45% will be received in March. So our focus is on what is cash collected during March. That is our focus. Let's start. Question number 293. 293 talks about cash collections. So anyway, March months, a percentage of it will be collected. March sales. March sales are how much? Every month it is uniformly given as 28,000. So we would see that March month same sale, February month also same sales. So if that's the case, 50% of this month 280,000 and 45% of the previous month, altogether it is 95% which is collected. But let's present it in different ways altogether, because it's uniformly the same amount. March sales are given to us as 28,000 into 50%. Next, previous month is February. February also has the same amount of sales. On an average, every month has the same percentage, same amount of sales. Just add it up. 5% anyway would not be collected. That's bad debt. So add it up. We have the total cash collections during March. Let's do question number 300. This is about the purchases. So the way sales are made on credit basis, purchases also is possible to be made on credit basis. So when it is on credit basis, then what do we do? Let's take it up. Question number 300. budgeted amount to be paid So we see that the following details have been extracted from the payables record of X Limited. Invoices paid in the month of purchase 25%, in the first month after purchase 70%, and 5% is paid in the second month after purchase. Purchases for September to July to September are budgeted as follows: July, August, September. So if we start with July, see, a part of the amount is in July, another part of it is in August, and another part is in September. So there are the payment is spread over in 3 months: July, August, and September. Because 25% will be paid in July, 70% will be paid in August, and 5% will be paid in September. Then if we start with August, it will be August, September, and October. But we are only looking at September. Then comes September, a part of it will be collected during um, September, a part of it will be paid during September. Then October, November, anyway, is not a part of our question. So we are only looking at whatever is the payment made during the month of September. So September payments are related to September purchases, August purchases, and also July purchases. So we have to consider all three of them. So to have it as a better clarity, let me put it as all 3 months. One question. If we take it up for 3 different months, it would be little clearer. Of course, they are only asking us for month of September, but then still I will be looking. I will be showing you for all 3 months. So how does it work out is what we will look into. July, then we have it as August, then we have it as September. Done. So if the, July sales are there, July sales, what are July sales? 250,000. So out of 250,000, 25% is paid during July, then 70% is paid during August, then 5% is paid during September. Next, August. Sorry, I wrote it as sales. It should be purchases. I'm really sorry. August purchases, August purchases, the first amount is 300,000. So is equal to 300,000 into 25%. The August purchases start from payment in August, which is 25%. And then a part of that, that is 70%, is paid during September and 5% in October. Okay. Then comes September purchases. September purchases amount is 280,000. So 280,000 into 25%. So this is how it works out. So this is how we see that as many number of months it's given. Of course, they are not asking us to find out what are the total payments during the month of July, August, September, but just to make you, I mean, understand about how does it work out the payments or the receipts part of it, it looks like this. So when, because it's only asked for September, if we add up the September amount, 292,500, that is payments during the month of September. Next, let's take up 298. Question number 298. A company has a current cash balance of 7,000, total receivables of 15,000, and trade payable of 40,000. The company can sell goods costing 50,000 and 70,000 next month. One half of the sales are collected in the month of sales, and the remainder in the following month. All purchases are made on credit and paid during the following month. Inventory levels will remain constant during the month. General cash expenses will be 60,000 during the month. What is the cash balance at the end of the month? So it's a question which has the receipts part of it, collections part of it, and also asking us to find out what is the cash balance at the end of the month. So a cash budget has three sections. I have already mentioned that. So first section is what we have it as cash receipts. The second section is what are cash payments. Okay, then we find out whether there is any surplus or deficit. To this surplus or deficit, the opening balance of cash will be added. So plus we see opening balance of cash. If it is added, then we would find out what is the closing balance of cash. So here in this problem, we are asked to find out what is the cash balance at the end of the month. So if opening balance is added, the resultant figure is closing balance. So we need to have all these steps. The first part of it, cash receipts. See, they have an opening cash balance of 7,000. This is one part of it. Then it says trade receivables of 15,000 and trade payables of 40,000 is also there. The company can sell goods costing 50,000 and 70,000 next month. Sales for the next month, the cost of it is 50,000, but the sale happened at 70,000. Of this 70,000, one half of the sales are collected in the same month. The other half of it is collected in the next month. Purchases are all made on credit and paid during the following month. The inventory levels will remain constant during the month. General cash expenses will be 60,000 during the month. So now in this case, the first part of it is, are there any cash receipts? 298. Sale worth is 70,000. How much of it is received is what we are focusing on. We are not talking about when did the sale happen. We are talking about when is the amount collected or when is the amount paid. That is all what we are only focusing on. So the sale is worth 70,000. Sale is worth 70,000. Half of the sale is 35,000. So 35,000 will be collected in the same month. What about the remaining 35,000? It will be paid, it will be received, it will be collected in the next month. So likewise, every month, a part of it is collected in the same month, a part of it is collected in the next month. So like that, the cycle goes on. So the collection part of it, one part is collected now, another part of the same month sales is collected in the next month. So like we are moving into the forward, something which happened in the past also might have come to the current period. So that is also very important. So on that note, we see that there is one item called as the trade receivables 15,000 and trade payables 40,000. So trade receivables, let's only focus now on trade receivables. Now trade receivables, what does it mean? Amount which was not received by the end of the period. So last month when they close the accounts, by the end of last month, they see that one part of the amount is still not received from the customers. So it's appearing there in receivables. So the receipt, the credit policy talks about only one thing, one portion in the same month, one portion in the next month. So by the end of previous month, if a portion was not received, when would it be received? It will be received in this current month. It's not spread over many months, it's just spread over 2 months, the same month and the next month. So we see there are two cash receipts. One is about current month sales. Current month sales are 70,000 into one half, no, 50%. Or just right. Then so the previous month, whatever sale happened of that, one portion is still pending. One half in the same month, one half in the next month. So previous month's amount which is not collected from the customers, the entire amount will be collected in the current month. So opening balance of trade receivable 15,000. We do not see any other things of about receipts. We do not have any other item of receivables. Only these two things are there. One is cash, current month sales. Of that, 50% will be received, collected during the month. And previous month, whatever was not collected, the entire amount will be collected in the current month. So add them up. Add them up. This will become total receipts. Put an alphabet A. Then let's check out about the cash payments. Cash payments, the terms are when the purchases are made, all purchases are made on credit and paid during the following month. So if there was any purchase made during this current month, the entire amount will be paid in the next month. So but what will be paid in this month? Whatever was pending in the last month, The entire amount will be paid during this month. So that's the only thing. We do not have it split into two parts and then this month, the next month, or previous month and this month. So no such thing. The total amount is on credit basis. The entire credit due will be cleared in one go in the next month. So if we are to talk about the cash payment of this month, we have to look at whatever was the um, credit purchase happened in the past month. The past month unsettled amount or unpaid amount is reflected by the trade payable. The cash payments, we see that opening balance of trade payables. Is there any other payment? There is one more payment which is mentioned. Inventory levels will remain constant during the month, and then general cash expenses will be 60,000 during the month. So we see general cash expenses. Only two items are there. Add them up. These are total payments. Now find out what is surplus or deficit. How do we get that? We just deduct A minus B is what is surplus or deficit. So the total receipts is 50,000 minus the total payments is the deficit. We have also the opening balance. You can also write it here, opening balance of cash. Opening balance of cash is 7,000. The first line, just check that. So when we add it up, so we see that there is closing balance. So closing balance, this is basically surplus or deficit plus opening balance. We still see that there is a negative balance of 43,000. So they still require 43,000. Then arrangement to that extent will be made. That is, they will arrange for a short-term loan of 43,000. So that's how cash budget is prepared. So let's get back to that. Please copy this. Let's get back to the PPT and then finish off whatever are the remaining topics which are there in the PPT and then discuss about that. And then today we will also move to the next topic called as capital budgeting. Okay. So I'm taking you to the PPT. So that's how a cash budget is prepared. Whatever are the other questions, you please practice. Anyway, college also, when your program is taken up in the college, at that time also you will get a chance to work out many more questions about cash budget and then capital budget and other types of budgets also. So after cash budget is done, so the concept of what is budgetary control? What is budgetary control? When a budget is prepared, when the budget is agreed upon. Now the concept of agreed upon, arises when it is a participative style of budget. If it is an authoritative style of budget wherein the top management prepares the budget, the budget is communicated to the employees in the organization. The rest of it follows. We do not see that there is a need for agreeing on the budget. It is just imposed on them, and then employees take it up, and then they implement that. But then, in case of a participative style of budget, where employees are also involved in preparing the budget, then when many rounds of negotiation take place, they agree up. They have to be a consensus. Everybody has to agree upon the budget. So budget is finally agreed by all of them who are involved in that. After that, the amount is incurred, expenditure is incurred. There is a comparison between what is the budget versus what is the actual. Actual is compared with the budget, whether it is going according to what is the budget. Then if there is a deviation, if it is not according to what was planned initially, then reasons are looked into why there is a deviation. Is it because there was fluctuations in demand has risen or it has fallen, or the resources, the prices have increased, material cost has increased, labor cost has increased, some things which were not anticipated, because it was not possible for them to understand that, something which happened suddenly, unexpectedly. So on account of that, if there is any change, or is it because of inefficiency that they were not able to incur as per the plan. So what are the reasons are identified, they are looked into, and appropriate measures are taken to control the deviations. Then in considering all that, the next year when the budget is prepared, um, if needed, it is revised or it is prepared considering all these changes which took place during the period. So that's called as a budget cycle or budgetary control. This is how control happens. Control is possible only on comparison. So the actual data should be compared with the budgeted data. Then only it is possible to take corrective measures and then control the cost. After that, we have a concept called as what is fixed budget and a flexible budget. See, when plan is prepared, the plan I mentioned on in the previous class, the basis for all the plans under operating budgets, we see that sales is the basis. How many number of units would be sold is first estimated. That is the first step which has to be anticipated. If they understand what's the demand, how many number of units would be sold, then according to that, the rest of that will be taken up. That is how much would be the production, then how much would be the purchase of material, labor cost, etc. All those things will be taken up. That is possible when um, the activity level or the sales unit level, that's known. So when that is when this can be known, the sales amount, or what we also call it as level of activity level, at what level would they be operating. If that is known, if that is possible to know, then the rest of it follows. Okay, the other activities would follow. So this all looks fine, but is it possible to estimate what actually would be the level of activity for the future? Future itself is uncertain. We know that future is uncertain. If it is uncertain, estimating that precisely is a very difficult task. So even after they take up all the measures to estimate it very closely, sometimes we see that some unexpected or unforeseen thing may happen, and the level of activity may not be anything closer to this one. Let's say they have anticipated that the sales level would take place at 50,000 units. So this is what is the plan, the budget. But maybe certain things have taken place during that period, and then suddenly their demand has increased. The actual activity took place at 60,000 units level. If they sell at 60,000 units, then in that case, see the items under 50,000, what is the sales, what are the costs about material, labor, overheads, all of them, everything is focused at an activity level of 50,000 units. This is the activity level at which all the values are given, starting from sales, then all types of expenses, etc. But the activity took place at 60,000 units. Are they comparable? Can we compare the performance of first year student with second year student? Second year student definitely is much ahead of first year student in every term, in every sense, because the amount of training what they have received is different from the first year student. They are definitely or not on par. Their performance cannot be comparable. They are not on par. It is not fair to compare the performance of these 2 year students. So in such situation, what do we see here? What do we do until the first year student comes to second year, finishes second year, then second year performance is measured? Or what was the performance of second year student when he was in the first year? So either ways, what we do is we take the level which is on par with each other. That is how it has to be measured. So also, when the activity levels are at different levels, the activities are at different levels. One is at 50,000, one 60,000, any two different levels. The actual cannot be made on par with the budget. Actual activity has already taken place. That cannot be modified to the budgeted level, but rather budget can be revised according to the actual activity. So when the budget is prepared, in itself it's a fixed budget. So they have prepared certain things at a fixed level of activity. But once they understand that that is not a possibility, they they prepare multiple expected levels. So maybe while while estimating itself, they understand that maybe the sales could be 40,000, 50,000, 60,000, 70,000, multiple levels. If they anticipate, for each of these levels, the budget is prepared and included in a statement. So the flexible budget will be at 40,000 units, what is the cost? At 50,000, what's the cost? 60,000, what's the cost? Cost and revenue for that matter. Then 70,000. The budget has many activity levels for which the estimated values are included. Then when the actual happens, so at the time of when the actual happens, let's say if it is at 60,000, because the budget also has the activity level of 60,000, select that activity level of 60,000, use it for comparison. When actual has to be compared, that should be compared with the activity level at 60,000 in the budget. So that is how. So when there are multiple levels of activity for which budgets are prepared, we call such a budget as flexible budget. This is to accommodate the comparison. If such a thing is not there, even if it is compared, the activity level of 50,000, the activity level of 60,000, even if they are compared also, it doesn't make any sense because they are not on par. The whole activity, the whole purpose of preparing budget to have budgetary control is not possible to be achieved. Okay, so that's the concept of fixed and flexible budgets. Fixed budget is at a level which is fixed, but flexible budget is original expenditure levels for activity, for actual activity level. That's the flexible budget or flexed budget. Where now fixed budget, then actual result. When this fixed budget is adjusted according to the actual results, it's called as a flexible budget. So the difference between fixed budget and flexible budget is called as volume variance. The difference between flexible budget and the actual budget is called as expenditure variance. Please make a note of that. So we'll move ahead. I think I have mentioned that we'll revisit one slide and then we'll come back to that slide. See, I was talking about there are behavioral aspects. There are three behavioral aspects: uh, participative budget, then motivation, then incentive schemes. There are two types of budget preparation. That is, one is authoritative style of budget, and the other one is participative style of budget. Authoritative style of budget, the top management prepares the budget and communicates this to the other levels of management. Then we see the participative style of budget. The feedback from various employees is collected, incorporated into the preparation of budget. um, so we see the advantage in participative style is um, they feel motivated, but there is a major disadvantage here in case of participative style of budget. We call that as a slack. SLACK, slack. So what does it mean by slack? See, the budgetary control, the budgetary control one major step in budgetary control is the comparison of the actual performance with the budgeted figures. So the actual should be compared with the budget. So that is about budgetary control. So the participative style of budget, the employees know that in future when they implement the budget, their actual results will be compared with the budgeted results, and they will be evaluated based on that. There would be accountability. So at the time of preparing the budget, instead of giving the right amount of budgeted figures, they can include excess cost. So something, if it costs 50,000, instead of giving the feedback that that item would cost 50,000, they will mention that it would cost to them as 52,000. So that is kind of a relaxation. They don't have to put in too much of effort to cut down the cost. Even if they don't put much effort also, there is something wherein they can relax. They don't have to be all the time very cautious about how they are spending the cost, because they have contributed the feedback as the cost of item is 52,000. So they can be relaxed, and even if they spend 52,000 also, they're still evaluated as best. They spend 51,000, they are evaluated best, and they are considered as achievers, cost savers. But rather now they should have been um, evaluated as excess cost spending employees. But here now they are evaluated as the best employees, saving some amount of cost. That is actually not saving, that is inefficiency included in the budget, because their participation was called in for. They were asked to contribute their feedback, give their inputs. They have given inputs which are wrong items, wrong estimates. So on account of that, we see that slack is included. Slack, or what we call it as inefficiencies, excess cost, loose standards, these things are included. That's the behavioral aspect. Just because they do not want to be evaluated and strict actions being taken against them, at the time of preparing the budget itself, they um, include loose standards or excess cost into the budget, so that in future they would not be made accountable for their decisions. One behavioral aspect. Second one, motivation. Motivation. The whole process of budget preparation should motivate the employees. So right at the time of preparing the budget, it should be motivating to them. They should feel that their opinion matters. Fine. Then later on, they should feel motivated to achieve the targets which are included in the budget. Next, incentive schemes. What are about incentive schemes? When the budgets are prepared, they would be evaluated in future. At the time of evaluation, at the time of performance measurement, they should be entitled to receiving some incentives. The incentive should be attractive. If they are attractive, they they put in their efforts to work towards the achievement of the targets. So the incentives should be motivating the employees to work harder and then receive the incentives. If they are very, very minimum, they do not feel motivated in the first place to work hard and receive the incentives from the organization. So these are all about the behavioral aspects. So in future, when you come to PM, studying PM and APM, these things again repeat. For the moment, just remember this. So with this, we finish with the topic called as budgeting, budgetary control. Now we come to chapter 14. What is capital budgeting? Capital budgeting is in an organization, the first step what is considered is raising of capital. Capital is raised. That's the first step. Once the mission is understood, the objectives are identified. After that, they work towards the achievement of the objectives. To achieve the objectives, what is required? What is required is um, step number one is about raising the capital. Capital has to be raised. Why would they require capital? To run the business, capital is required. Then this capital is invested in projects. They are invested in assets. They are purchased so that the business activities are taken up. So capital is raised. So this has to be invested into assets, invested into projects. Some activities are taken up. But once the capital amount is invested, whether it is a profitable one or not, or whether this investment is a worthwhile investment, um, can be understood only in the future when they receive the returns from that, when they start earning profits out of these projects, then only they understand that. So, but then do they have to wait until the time period is done? Let's say that if a project life is for 5 years, should they wait for 5 years to understand whether this is a profitable project or not? So that would, if it is not a profitable one, their 5 years of time would be lost, and also the investment amount also would be lost. So even before investing, so for the future period of time when the investment amount is taken up, whether it is a worthwhile investment or not, whether the investment proposal should be accepted or not, is what has to be understood. So what's the big issue with that? See, when investment is made, capital is made, capital amount is invested into project, whether it is profitable or not can be understood by taking into consideration what are the cash inflows or what are the returns, what we call it as. So how much returns will be earned from the investment, cash inflows. But do we see that inflows come only for 1 year? They are spread over a number of years in the future. So starting from 1, 2, so on till the nth year, cash inflows would be earned. So add them up, estimate all the cash inflows which are expected. Let's say that if you invest in a investment proposal, if it says that, if it promises that for the next 5 years you will receive this amount, so that is the promise which is given on the investment. So you consider that how much return will you get, compare it with the investment cost, and then if the returns are better, it is worthwhile to invest that, or the proposal should be accepted. So as simple as that. What do? We consider all the returns which can be earned from the first year until the last year, add them up, compare it with what is the investment cost. If the returns are better, go ahead and invest it. If they are not so, just reject the proposal. Simple. If that is that simple, what is that we have to learn in this? So you must have heard from your parents or grandparents, elders in the family, that in their day or during um, the olden days, or when they were young, or that maybe they would have mentioned that your parents would have mentioned that in our days with 100 rupees we were able to do so many things, or grandparents, they talk about with 1 rupee we used to do so many things, and they talk about currency which we have never heard about. You people must have not heard about it. They also mention about what are the paise thing, how many paise, or even for even before that also some other currency coins they mentioned. With those things we were able to do that. We don't even think about using 1 rupee and then getting something very great. 1 rupee is not even considered off late. See, 100 rupees also has not much value, wherein you can get many things out of 100 rupees. But your parents must have mentioned sometimes in your families that with 100 rupees they were able to do so many things. You must have heard about that. What happened to that thing? Why is it not possible now? What your grandparents were able to do few years back with 1 rupee, now 1 rupee doesn't seem to even exist, or it doesn't seem to have any kind of value which can be achieved. 100 rupees also we do not see that it can be great things can be taken up out of 100 rupees. So what happened? The value of those currencies have reduced, the value has decreased. So as the time passes by, one important point what we understand is, as the time passes by, the value of money decreases. So whatever the investment promises to be, the investment promises to be paying in the future, it will definitely not have this value, but it will have a discounted value. It will have a lesser value. So when the cash flows which are expected to be received in the future, if they are not at the same value, first point what we have to do is we have to find out what exact value will these future cash flows have. So we need to understand how to discount them. How much would be their value in terms of the quantity? It could be 10,000, 20,000, something like that. The face value of the cash flow would be the same, but the actual value, the purchasing value, the value which it possesses, it will not be the same. It will have at a lesser value, or we call it as discounted value. So step number one is what we have to do is we have to first discount all the cash flows. After we discount all the cash flows, then total it up and then compare it with the investment amount. So that is the concept about the capital budgeting. What we have to understand here is what are the future cash inflows that has to be compared with the cash outflow or investment. It's going out, so investment. So whichever is better, whether it is investing in this project is better in terms of better returns, then accept it. If otherwise, if investment is greater than the cash inflows, reject the proposal. Invest in some other project. So that's the concept of capital budgeting. So we first have to understand what are the cash flows. They are earned in the future. They may not be the same amount. It could be incremental, that is year after year, there must be some increase in the cash flows. And what are the cash amounts? The benefits which are expected to be derived, it should be there in terms of cash inflows. Um, then how would be discount them? So to discount them, there are various types of interest: simple interest, compound interest, nominal interest rate, effective interest rate. These are different types of interest rates. Um, at those interest rates, so whatever is the interest rate at which the cash flows have to be discounted. So the techniques which are there for us is, the first one is payback period, the second one is net present value, third one is internal rate of return. Then we have a concept of what are annuities and perpetuities. Annuities and perpetuities, I will explain to you about what is the meaning of it. Annuities is annually the same amount of cash flow when it is earned, it's called as annuity. Perpetuity is forever. If you invest in a sum of money in today's date, forever there would be a return earned from that. See, that is possible when you invest in shares of a particular company. There is no maturity period. As long as the company exists, returns can be earned. So that's called as perpetuity. There is no ending. There is no lifetime. There is no span of time. That is called as perpetuity. Let's focus on what are the techniques. The first technique is called as payback period. Let me just highlight this one. So what are we trying to calculate here? We are trying to calculate about a period of time. This technique of capital budgeting talks about what is the period of time. Rather, when the investment is made, in how much time will the investment be paid back? Let's say if an investment costs $1,000, okay, if they have returns earned from this project as 500, 500, 500, let's say that they earn this return. So what do we see that the investment cost is 1,000, the returns are, we see that one is 500, next year also 500, third year is also it's 500. So this is a simple example. So what do we see? If the life is for 3 years, out of 3 years, within 2 years, they can get back their investment. When is the investment paid back? Pay back period. So from this small example, we understand that the investment amount will be paid back in a period of 2 years. Do you understand the concept? Is that clear? The investment is paid back in a period of 2 years. But one second, there are students without audio switched on. I'm just putting them on the waiting room. For what purpose did they come? Okay. So we see that amount of 500, 500 together it is 1,000, so 2 years. But just now I have mentioned that whatever are the future cash flows, these future cash flows do not have the same value. As the time passes by, the value of money decreases. As the time passes by, the value of money decreases. So 500 will not have same 500, it will have a lesser value. The next year 500 will have even further decreased value. As the time passes by, the value of money keeps decreasing. Accommodating that adjustment, we need to calculate what is payback period. I hope the concept is clear. Let's take up an exercise question. Question number 323. Let's take it up. Question number 323. I'll put it in the Excel sheet. 323 on the screen. A company is considering an investment of 400,000 in new machinery. The machinery is expected to yield incremental profits over the next 5 years as follows. The first year, at the end of first year, 175,000, second year 225,000, third year 340, fourth year 165, fifth year 125. Thereafter, no incremental profits are expected and the machinery will be sold. If it is company policy to depreciate machinery on a straight line basis over the life of the asset. The machinery is expected to have a value of 50,000 at the end of year 5. What is the payback period? Let's first understand what are the terms which are mentioned. We see that there is an investment cost. Investment cost is 400,000. What's the life of the asset? The life of the asset is 5 years. See, at any given point of time, if something is not clear, please stop me because I am explaining all the adjustments concerned related to this one. So anything which you feel that it is not clear, you please stop me. Fine. First point is the asset investment cost is 400,000. I'll keep writing everything. So you also keep making a note of that. 400,000 is the investment cost. What's the life of the project? The life of the asset. The machinery is expected to yield incremental profits over the next 5 years as follows. So, life of the asset. We see it is 5 years. Then the after so 5 years there are some profits which are expected to be earned, but at the end of the 5 years time period they see that there is a salvage value. That is, if it is sold, it can realize 50,000 salvage value. So let's write salvage value. Then after that, we see that There are profits given from year 1 to year 5. Profit. What is profit? Profit is equal to the sales revenue generated minus total cost. The total cost includes all costs which are paid in the form of cash. Non-cash expenses are also included. Non-cash expenses like even if it is not paid, if it relates to the current period, outstanding expenses, etc., we see that. One major item of non-cash expense is depreciation. Depreciation is the wear and tear value of the asset. There is no cash which goes out of the business on account of depreciation, but it is an expense which is accounted in the current year's period. So total cost includes depreciation also. From this information, we see that that's the only possible thing which is included. So total cost including depreciation. I'm very specifically writing any non-cash expense for that matter, including depreciation. So that is also included. But we want only cash profits. So we see relevant cash flows should be in only those transactions which are in the form of cash. Non-cash expenses should be eliminated. So they have calculated the profits. The profits are calculated by deducting cash expenses and depreciation expense also. How much was the depreciation? So here we see that depreciation is equal to, what's the formula? Do you know the formula? Plus 2 you must have learned. Any one of you? Anyone listening to me? That is a big doubt I have. If it is a straight line method, the formula for depreciation is equal to cost of the asset minus salvage value divided by life of the asset. Did you ever do any particular formula or depreciation related question or depreciation problems? Response students, anyone?
Yes, we did it, ma'am.
So you know this one. So we can, and the question also very clearly mentions that they are following straight line method of calculating depreciation. So just calculate what is depreciation. Is equal to, we see cost of the asset is 400,000 minus salvage value is 50,000 divided by the life of the asset is 5 years. 70,000 is the amount of depreciation. See, they have calculated profits. Let's mention here year. Then we have profits. Year starting from 1, 2, 3, 4, 5. And profits are 175,000, then 225,000, then 340,000, 165,000, then 125,000. But what is profit? Profit is equal to sales minus cash expenses minus depreciation. Now, what is the right way of doing it? No depreciation should be deducted. But how much is depreciation every year? Depreciation is equal to depreciation each year is equal to 70,000. So every year they have deducted 70,000. They should not have deducted depreciation, but they have deducted depreciation. What should we do? If it should not be deducted, but it was deducted, so to nullify the impact, what step will nullify the impact? We just add it back. Profit plus depreciation is equal to cash flow. So we want cash flow. Cash inflow is equal to profit plus depreciation. Add back depreciation. Do you see that? Now these six should be taken into consideration for comparing with the investment. Investment cost is 400,000 and then take a decision. Now, if the life is 5 years, the amount of investment should be paid back before 5 years. That's the point. How do we understand? So, to know, by the end of first year, 245,000 cash flow was earned, but investment is 400,000. So, what do? We consider the next year's period also. So, next year's period, we add it. So, to understand that, what we do is we cumulate cash inflows. Cumulate cash inflow.
శరత్ ఊరక హైట్ ఉంటాడు బక్కడే కదా ఇళ్ళలో ఎవరు పెద్ద కనుక్కోండి అని చెప్తాయి.
So cumulative cash inflows would be by the end of first year, the total cash inflow is 245,000. Next year, so 295,000 plus the previous amount. What is the investment? 400,000. So by the end of first year, we see that it is only 245. By the end of second year, it became 540. So in between these two periods, that is the first period and the second period, we see what is the payback period. It lies between year 1 and year 2. So we want to know precisely what is the time period. How do we do that? See, a major part of the amount is paid back by the end of first year. So take first year. Payback period is equal to a part of the amount is paid back by the end of first year plus we want the balance of it. How much was paid back by the end of first year? 245,000 was paid back. So how much more has to be paid back? So that is out of 400,000, we want the balance of it, which is after deducting 245,000, whatever is the balance. How much is that? 400 minus 245 will be 55 here. 155. 155,000. We want to see the next year it is 295. Out of 295, we are only bothered about 155. So what fraction of the year will this amount be collected? Just check that. So that's 1.52 years. 1.5 years. 1.5 years. That's the period when the amount of investment is paid back. So the total amount of 400,000 is paid back in a period of 1.5 years. Is that clear? Every step of it, is that clear?
Yes, ma'am.
So let's go to the next technique, which is net present value. Here we have taken the cash flows, whatever are given at their face value. If it was 175,000 plus 70,000, 245,000. But one explanation what we understood was the cash flows have a discounted or a reduced value. So the next technique, is net present value. We also call it as NPV. What does it do? Whatever are the future cash flows, what value do these future cash flows um, as on today? So if 10,000 is expected to be received after 1 year, as on today, what value would it have? Because we already understood that it will have a reduced value. There are theories which are based on which it says that a simple concept logic I will explain to you. How, I mean, what do we understand by saying that it will have a reduced value? Let's say if you have 100 rupees with you. When you have 100 rupees with you, what do you do with that? Um, See, Farhan Khan and Jairam Gandhi are students of which college? Is it St. Joseph's City or Garden City?
Farhan of Garden City.
Jairam Gandhi, St. Joseph's.
Yes, ma'am. He's from St. Joseph.
Let's say that you as an investor, you hold 100 rupees with you. A simple example. If you deposit it in a bank, so deposit in bank. Bank it pays, let's say the interest rate is at the rate of 5%. So after 1 year. So this after 1 year, what will happen to this 100 at the end of 1 year? 100 will be there intact, 100 plus the bank also will pay 5 rupees interest. So this is totally 105. If there is 105 rupees 1 year later, that is worth 100 rupees as on today, or today's 100 rupees is equal to 105 rupees 1 year later. This is a very, very simple and basic example. Why are we talking about the value of money decreases? If we are talking about that, this can be better understood with an example. If a person has 100 rupees with himself, if he chooses to deposit in a bank which pays interest at the rate of 5% per annum, after 1 year, this 100 will be 105. 500 investment plus 5 interest. So if at all, if a person has 105 1 year later, that is equal to having 100 as on today. So if the project is promising to give returns in the future after 1 year, 2 years, 3 years, so on till the nth year, some amount, they will not have the same value, but they will have a lesser value as compared to today. 1 year later, 105 rupees is equal to 100 rupees today. So whatever are the returns which the project is promising, those returns or those amounts, those cash flows will have a lesser value as compared to today. So for that point, what are we supposed to do? We have to discount all the cash flows as on today's value. Find out what is the present value of all the future cash flows. After that, add it up and then compare with the investment. So that's the concept of net present value. Straight away, let's take up one question, numerical question. While working it out, we will try to understand it a little better. I'll get one question from the examination kit. On the screen, question number 316. B company is deciding whether to launch a new product. The initial outlay and the forecast possible annual cash inflows are shown below. Year zero is today. Today is called as year zero. Now the present time is called as zero. Okay. So today's investment is 60,000. If they invest an amount of 60,000 as on today, year zero, the next 3 years, year 1, year 2, year 3, there are some amount of cash inflows expected. 23,350, 29,100, 27,800. These are the expected cash flows. Fine. The company's cost of capital is 8%. Assume the cash inflows are received at the end of the year and that the cash inflows are for each year are independent. So let's write, see here it is not profit like the previous question, it's not profit, it's straight away we have cash inflows mentioned. We can directly take them as cash inflows. Year is starting from 0. Then cash inflows, which are minus 60,000. Then 23,350, 29,100. Excel sheet only you're able to see, no? One more important point which is mentioned in the question is cost of capital is given as 8%. So the cash flows have a discounted value. How do we calculate that discounted value? That is mentioned by way of a percentage, prevailing interest rate, market, the market value of the interest rate, or nothing is there, we calculate weighted average cost of capital. I think all these things you will take it up in FM paper. So right now I will not touch, but some rate which is mentioned at which we have to discount them. How do we do that? See, the formula of calculating the interest rate, compounded interest rate, you must have learned in your school math. That is A is equal to P into 1 plus R whole to the power of N. You must have learned that in your school days. The same logic is used, and we do not have to use a mathematical formula, but rather the table values, all that calculation is simplified and presented in a table value. So we take up the table value. I'll just show you how do we do that. Every financial management textbook, at the end of the textbook, you will find these table values. Right now, I don't have so much time to spend on how to take it up, these things. Anyway, all of them you will learn again in detail, thoroughly in FM paper. As of now, I'm just showing you how to take up the table values. One second. I'm trying to open it in the Google thing. See, these are table values. We would see that vertically the first column is the number of years periods and the rate is mentioned here. What is the rate which is given to us here in this particular question? It is 8%. 8% 1 year is 0.91743, 1.75. No, this is annuity. Sorry. One second. I'll put the right table. Annuity. Okay, now you see there are 4 different tables. You will learn about that in the right time. But as of now, let's just see this one. The interest rate is 8% here. Horizontally, we have the interest rates, and vertically, we have the time period. The time period for us is 3 periods, 1, 2, 3. Those are the years given. See, 8% we see 0.92593, then 0.85734, then we see 0.79383. So let's get back to the Excel file quickly. I think it's time. So let's get back to the Excel file. So we need to first find out what is the present value factor. Take it from the table values. All financial management textbooks have these table values. Present value factor at 8%. 8% is the rate which is mentioned. So if today's value will have the same value, today 100 rupees will be 100 only. So 60,000 will have the same value, 60,000. So multiplied into 1, it will be the same. But 8% we see that the values are 0.92593. The next year we have it as 0.85734. The next year we have it as 0.79383. Okay. So the present value of cash flows. The next column is present value of cash flows. So this is net present value. NPV is equal to. What's the logic here? See, we are comparing the total inflows. These are 3 amounts, total cash inflows versus cash outflow. Outflow is a negative figure. So total cash inflows minus cash outflow is equal to NPV. I'll write the formula here for your understanding, better understanding. Net present value is equal to total present value of cash inflows minus cash outflow. So the total amount of these 3 things will be cash inflows are the total amount. Let me just calculate that and then tell you. Auto sum of these 3 amounts is the sum total is 638. So here it would be basically 68,638 minus minus cash outflow. Outflow is 60,000 minus 60,000. So basically we have it as is equal to 8,638. 8,638. That is the meaning of it. What does it indicate? It indicates that the total present value of all the cash inflows, inflows are returns, profits. Those inflows are better than what they are spending. How much are they spending? 60,000. So for an investment amount of 60,000, the benefits are 68,637. So 68,637 minus 60,000 is 8,638, which is a positive figure. So if it is a positive figure, the project should be accepted, otherwise it should be rejected. So that's the concept here. So here we would have it as 8,638 positive. So accept the project. The decision will be accept the investment proposal. We'll continue tomorrow. Today, the beginning of the class, so much of time got wasted. Of course, certain problems also arise. So it is perfectly understandable. Done. I'll see you tomorrow, same time, and then we'll continue with capital budgeting and take up the other topics also. I hope it is clear. Any doubts, I'll take it up tomorrow because it's already time. Is that fine?
Ma'am, will the
Will the
links for GCU be updated? Because today we couldn't log in because there was
actually,
no.
I think there was actually the class is scheduled as at the beginning of the all the sessions only. It was all scheduled in LMS. So I don't know what was the technical issues. So tomorrow, if you again face a problem, contact your coordinator. I don't think there should be any problem tomorrow arising because the calendar was showing it as a combined class only, but no clue about why it happened.